Nifty is falling and your sold puts are bleeding. The panic is starting to set in. If you have ever felt stuck in such a trade where every down tick makes your heart race, this video is for you. Welcome to the Option School. I'm your friend Pradeep Singla. We are going to look at a real life back tested trade that proves how you can turn a sinking ship into a profitable trade. Let us look at the market context. Between late October and early November 2025, Nifty saw a sharp fall of 3.08%. In point terms, that's nearly an 800-point drop in just few trading sessions. When such a fall happens, only sufferer is the person who has sold puts, because the person who has purchased puts is happy, he is making profit. The person who has sold call is happy, he might be making profit. The person who has purchased call may not be so happy, but he's not very stuck because a purchase call will have a very limited loss. But the person who is having a sold put can have unlimited loss, and that is the most problematic situation to be in. Here we have taken an example of monthly sold put of 15 delta. Let me show you the payoff diagram. In the beginning of the series, as we can say, put is sold at 58.8 rupees, getting a total credit of 44.10. Break even is 25.142 and market is at 26.010. This is a bullish trade which is taken at the beginning of the series, that is on 29th of October. After the fall of market to 25,348, put price became around 152 and it started giving a loss of around 7,000 rupees per lot. Falling markets like this also increases VIX very fast, accelerating the momentum of loss, obviously creating a serious panic in the trader who is having such position. There is no such thing as a bad trade or a good trade at entry if you know exactly what to do when the trade gets stuck. Professional trading is not about being right 100% of the time. It is about having a remedy when the market goes against you or against your view. There are remedies available for such situations also. So let us see some of those remedies. These adjustments or remedies can be broadly classified into two heads. First is remedies which require additional capital. Second kind of remedies are which do not require very high additional capital, maybe just a low capital or no extra capital is required. In this video, we focus on the low capital adjustments because I want to show you how to fix a trade without pumping more money into a losing position. This remedy is very simple but very powerful. You know it, but when it comes to execution, are you able to do it? So we are converting the trade from a naked put to a bull put spread. The sold put on 4th November is at 89, whereas the initial price was around 59. Now to limit further damages, we buy a put at a lower strike. This effectively caps your maximum loss and prevents a total account blowout if the market continues to crash. So on 4th November, we have modified the trade from naked put to a bull put spread. How? A put of 24,900 strike is purchased at around rupees 47. By creating this spread, we aren't just now hoping for reversal, but we are mathematically defining our risk. Look at the new payoff graph now. The risk is no longer undefined. After 4th November, let us say on 7th November, let us look at the numbers before the adjustment and after the adjustment. We were down by 7,000 rupees on 7th November before the adjustment. Immediately after converting the trade to bull put spread, the M2M loss was contained. That's a recovery of over 34% of the initial loss we have seen. However, there is a catch. If the market reverses too sharply, this specific remedy can hurt your total profit potential, but yes, it will still lead you into some profits. And important to note that once the market starts reversing, we must get out of this bought put. This is what an experienced trader will do. When required, buy the protection, and when not required, do not keep the protection, remove it. Your ability to execute a simple trade in such a fashion makes you a much better trader. So in this case also, the bought put is removed as soon as the market stabilized. Got some loss in that, which is okay. But overall, by the end of the month, trader is able to manage a profit of around 2763, which is around 2.35%. So important points to note: when to buy the protection put, when to remove it. Do I need to really worry about the loss in purchase put? Ultimately, 2700 rupees profit is better than unlimited loss or even 2500 loss. Remember, it is very important to remain in the market, and that can be done only if your risk is defined. Also important to buy protection before market eats away all your premium. In this case, you must have noticed that sold put was at 59 rupees and bought put was at 47. So even if you have kept the trade till end without removing the put, still you must be landing in a 11 rupees profit. But since you are an experienced trader, what you have done, you have removed the put earlier, and the profit what we got at the end of the month is much better than 11 rupees. There can be four other remedies which can be deployed with or without increase in margin requirements. We are going to discuss more such remedies in part 2 of this video, so stay tuned. If this remedy helped you, please hit the like button and subscribe to the channel. Thank you.